Good morning, everyone. Welcome back to Financial News in Palos Heights. And today being October 14, 2019, we have Paul Munico from Ameriprise Financial to give us an update as to what took place in the financial market, Paul.
Thanks, Ron. So what we're looking at this week is corporate earnings taking center stage. So this week that we're in, 52 or about 10% of the S&P 500 index is scheduled to report their earnings for the third quarter, including 7 constituents of the Dow Jones Industrial Average. Through last Friday, just 24 S&P 500 companies had reported. Earnings per share for the S&P 500 companies are expected to be down 4.9% year over year on Q3, and on sales growth of a positive 3.3%. And these numbers are sorted from FactSet. A number of issues have been weighing on corporate performance for several months and will likely to do so over the near term. Of course, we've beaten this to death, but the U.S.-China trade dispute is a well-known factor that is having a negative impact on many companies, but in particular the technology sector. Companies in the energy and material sectors, meanwhile, are expected to see notable declines on both the top and bottom line due to lower commodity prices. The strong U.S. dollar, which is up about 4%, and weaker economic growth in key foreign markets is also expected to weigh notably on multinationals. Results in the financial sector are also expected to be under pressure from very tight interest net margins as a result of today's very low interest rate environment. And a few other factors to consider, but we believe it's important to note that some of these issues are also likely to be temporary in nature. Even the ongoing production problems at Boeing are an issue that need to be considered. Boeing itself is expected to drag the overall S&P 500 earnings per share results by 0.2% lower just from Boeing. And again, that's according to FactSet. So in addition to the negative impact on the overall market, certain companies like Boeing can drag it down even further. That's my update on earnings, what to expect for this week. Call me if you have any further issues or questions on earnings.
Well, I'm sure you'll get phone calls, Paul. You got to give your
There's
phone
a lot
number
going
at
on
the end.
Starting this week, so yeah.
You certainly will. Ameriprise Financial had also supplied us this morning with research notes, and they are as follows. The U.S. stocks are lower ahead of the open after Bloomberg report overnight suggested that China could delay phase 1 of the trade deal negotiated last week.
And that's that. We rallied last week on that news. We got that report Friday, and the market had a very strong run based on the phase 1. And from Friday till now, it seems like China might be changing their mind. So
I hope not. European equities are lower by nearly 1% as natural resources stocks lead to declines. Anything you want to add to that?
That one's pretty self-explanatory. Nothing there.
European equities are lower by 1%, and I just gave you that. The crude oil is trading off by roughly 2% as concerns mount over whether the U.S.-China trade deal can be completed.
Again, so all these sectors, all these different areas of the economies are looking at this trade deal.
Yeah.
We had the report from President Trump on Friday that the meeting went well and phase 1 was going to be implemented. And again, something must have happened over the weekend. And
I guess we'll hear more about this in the next few days, I'm sure, and then you'll be reporting that again. The U.S. bond market is closed today in observance of Columbus Day. And just talking about where interest rates are, I see that the interest rates have dropped for mortgages.
Yep,
and if Fannie Mae, from what I read over the weekend, is at 3.5.
And the Fed has been cutting rates all throughout the year, which we've reported, and there is reason to believe the Fed is going to cut further this year, bringing all those rates down even lower.
And then the last thing is the S&P 500. To give you year-to-date percentages, the S&P 500 is a plus 20% year-to-date, Dow plus 17%, year to date, and NASDAQ is a plus 22% year to date. And I just noticed that both the S&P 500 and Dow Industrials ended last week with 2% of their all-time high.
It was a good week last week.
Yes.
Hopefully we can at least hold those levels or continue to build on them.
Okay, well, stay with us. We're going to be right back. We're going to be talking about your money, and Paul's going to be talking about municipal bonds and who should be investing in it and how do you invest. Stay with us. We'll be right back. And we're back with your money, and as I previously mentioned, Paul's going to be talking about municipal bonds, and I'm going to ask Paul to explain to you viewers what a municipal bond is.
So in a nutshell, municipal bonds are bonds offered by government municipalities, and these bonds are known for having at least federal tax-free interest on the dividends that they pay.
And there are different types of bonds. Can you go into that?
There are. So the two main category of bonds for municipals are general obligation and revenue bonds. And the way they work, a revenue bond is just as it sounds. The interest that it pays the bond holder is derived from revenues from that bond. So an example might be if you're building a new bridge and that bridge has a toll on it. Those tolls help to pay for the bridge and help pay the interest on those bonds. Then the flip side there, that's the revenue bond. Then there's general obligation bonds. These are a little more straightforward, and that taxes typically pay the interest and dividends on these. So the municipality has the ability to leverage and raise taxes to help pay the interest on these bonds.
And that leads us into, are these bonds safe, Paul?
Well, bonds, all bonds have a rating scale. So you've got government bonds as your safest. These are not those, but you've got then what's considered investment grade bonds, and that's AAA, AA, single A, and triple B rated bonds. And these are all rated by independent agencies that rate the safeness of that issue. And then, of course, we can go into what's called junk bonds, and those would be triple B to single B to triple C, all the way down to non-rated.
Okay, you're investing into municipal bonds for an interest, and how does that work?
So that's important to note. Okay, so the interest is federal tax-free, and potentially, if you buy a bond from the state you live in, it could be state tax-free as well. We already said that revenue bonds pay their interest through revenue, and general obligation bonds pay interest through the levy of taxes. That interest goes through to the bond holder. But what's important, again, to note and why people invest in these is their tax-free nature. So oftentimes, before investing, someone will cite a taxable equivalent yield, which means what you'd have to get in like a taxable CD to equal what you're getting in the municipal bond. And there's ways to calculate that. You take your the yield of the bond minus your tax bracket and divide it, and you will get your taxable equivalent yield. I can help people with that calculation if they need to see it, but there are ways to calculate that, and then you know what an equivalent taxable bond would have to be to equal it.
Well, if this creates a lot of interest and the viewer wants to invest in it, how do you go about doing that?
So there's ways, and actually I want to go back to the taxable equivalent yield. I think I misspoke. You take 100 minus your tax bracket divided by that tax-free yield, and that gives you your taxable equivalent yield. This can be looked up very easily on the internet, or I can help people calculate it. Back to your question, what was it again?
If the viewer is interested in this, how does one invest into it?
Good. Yes. So there's multiple ways to invest in municipal bonds. One way is directly through the municipality. So I'll have clients that will call me up. I will pull up my inventory of bonds. I can tell them exactly what the taxable equivalent yield is, what the tax-free yield is, what the rating is on the bond, and who's going to issue it. They actually own the bond outright. That's one way to do it. A second way to do it is through a mutual fund. A lot of people are familiar with these. You hire a fund manager who will buy a portfolio of municipal bonds for you. And a third way can be through Exchange traded fund, very similar to municipal to a mutual fund, except the exchange traded fund trades in the immediate market, trades differently than a municipal mutual fund would trade. But those are three different ways: outright buying the bond, exchange traded fund, or mutual fund.
Do you have any closing remarks on municipal bonds? And what my concern is, I'm sure the viewers are saying, well, why don't I really get into this? Because I'm saving money on possibly state taxes. Maybe this is the thing that I should really focus on versus stocks or equity type things.
Yep, I mean, what I would like to close with is a lot of individuals in a higher tax bracket tend to lean towards these just due to their tax-free nature. And especially when you do calculate out your taxable equivalent yield, the higher tax bracket you're in, the greater that number looks to the investor. So high income producers, high tax bracket individuals typically lean towards these, but they do work for anyone. It's a good investment, and you just have to look at the ratings of your bonds, make sure you're comfortable with that risk, comfortable with that municipality. And
It's too early in the morning, Paul.
and there's risk with everything. These bonds, they're not guaranteed. They can go default. You can lose your money in them. So proceed slowly.
And the city can go bankrupt.
Cities can go bankrupt and
Yeah.
you can lose your money. It
Yeah.
has happened. These bonds do default. High-rated bonds can default just like low-rated bonds can. The risk of the high-rated bonds defaulting is lower, but it's still a risk that's out there. So understand what you're getting into before you make any investments in these.
And you should be talking to your financial advisor, and if you don't have one, they can call you.
Absolutely. My name is Paul Municle. I do work at Ameriprise right here in Orland Park. Feel free to call me directly at 708-226-3412.
Okay, well, thank you for bringing this topic to the show, Paul. For Paul Municle with Ameriprise Financial, myself, Ron Jankowski with Channel 4 and Palos Heights, we wish you a good investment day.